Hi guys, this video is about my September dividend reinvestment in my dividend growth portfolio, plus a review of the whole portfolio at the end. As you know, this year I've been focusing on my small positions, adding to some and dropping others from the portfolio. Let's see what I did this month. But first, before I get started, I have a request to make of you guys. Please click the thumb up button if you like this content, subscribe to our channel, and ring the bell to get notifications when we issue new videos. Those things help us out a lot, and I really appreciate it when you do them. Thanks. Before I tell you what stock I purchased this month, let me remind you that I create quality snapshots of every stock under consideration. If you want to see how I create them, please see my video called How to Quickly Assess the Quality of a Company from about 3 months ago. You can find that video in my timeline. This is a screenshot from that video. Now let's talk about my stock pick this month. It's Merck, ticker symbol MRK, the pharmaceutical giant. This display shows Merck's quality snapshot. In my snapshots, colors tell the story, and green is a great color. Dark green means the highest grade or rating that a company can get in the particular category. Light green means the second highest grade. And you can see that for Merck, it's a sea of green. All the ratings except one are the very highest rating, and only one, the credit rating, is a second level rating. On a point system that totals 24 points out of a maximum possible 25 points, which is an A on quality for Merck and really puts Merck in the highest tier of dividend growth companies as far as quality is concerned. I also create dividend snapshots for each company. My video explaining these was posted about 2 months ago, and again, you can find that in my timeline. Please go see it if you want more detail about how I rank the dividend characteristics of companies before I consider buying them. Here's Merck's dividend snapshot, and once again, the colors tell the story. Merck gets mostly average grades across the board on its dividend snapshot. Its increased streak at 10 years is okay. Its yield at 3.2% is decent, but not outstanding. Its most recent increase of 6.2%, which was last November, is okay for a mid-yielding stock. 3.2% is a mid-yield as far as I'm concerned. Its 5-year dividend growth rate at 7% per year is okay. Its 10-year dividend growth streak has been a little up and down, but it's similar right now to what it was 10 years ago at the start of the measuring period. So those all get yellow. But notice the first category on the far left, the dividend safety grade from Simply Safe Dividends. I consider this factor to be so important that I double the points available there from 5 to 10, and it so happens that Merck gets the absolute highest grade that Simply Safe Dividends gives for dividend safety, putting it in the highest category and giving it 10 points, giving Merck 10 points on that category alone. And that, combined with all the other okay categories, is enough to elevate Merck's total grade on the far right to above average. It gets 25 out of a possible 35 maximum points, and I consider that above average, or a B rating for Merck's dividend. Finally, when I'm considering a stock, I value it. I have a video on that too, posted about a month ago. I urge you to go check that out because valuation is important. By coincidence, Merck is the stock I used as the example in that video on how to value stocks. Valuation comes at investing from a different perspective. Whereas the quality and dividend snapshots cover characteristics of the company that help you decide whether you would want to own the company at all, valuation tells you whether the stock is selling at a good price. I firmly believe that paying too much for a stock is not a good practice because you want to create a margin of safety around everything that you own. Getting a stock at a favorable price is how you create that margin of safety. And that's all explained in the valuation video. So again, I urge you to go give that a look if you haven't already. Since I used Merck as the example in the valuation video, I'm not going to use time here going through all the details about the 4 valuation models that I use. I did update the valuation for this video, and there's good news. Merck's price has actually fallen since I made the valuation video, so its valuation has gotten better. And I show the drop in price by that little red arrow at the right end of the price line, the black line on the chart. That little drop in price may look insignificant in the total context of the chart, but it did increase Merck's valuation rating, and as a result gives us the benefit of the other things I talked about: a lower price, a higher yield, and so on. When I pulled my 4 models together this time in the update, here's what I get. A fair price of Merck for Merck of $100 per share. That's shown at the very bottom of the slide. The top part of the slide then creates valuation ranges. The yellow range in the middle is simply the $100 fair price plus or minus 5%. So in dollars, it runs from 95 to 105. Anything over 105, in my opinion, would be too much to pay for a share of Merck. That's shown in the orange area to the right of the chart. But on the left side, under discount, that's green because this is a undervalued area. It's below $95. And in fact, Merck is selling right now, and I bought it at approximately $87 a share with a 3.2% yield. And in my opinion, that makes Merck 13% undervalued. The math on that is real easy in this particular case because the fair price is an even $100 and the actual price is $87. Obviously, that's $13 or 13% below the fair price that I calculate for Merck. So I went ahead and reinvested my dividends for September into Merck, having such high quality, good dividend snapshot, and an excellent 13% undervalued valuation. I bought 6 shares of Merck, which increased my position from 41 to 47 shares, cost me a little over $500, and adds almost $17 to my annual dividend run rate by adding those 6 shares. The purchase also increased my position in Merck from 2.1% of the portfolio to 2.4%. That still leaves Merck a small position, being under 3%. So I will continue to look for good opportunities to add to Merck as the months go on and I reinvest more dividends. Now let's update the whole portfolio. Despite the volatile market this year, plus the Fed's raising of interest rates to combat inflation, which has some investors hesitant about investing right now, I am continuing my monthly dividend reinvestments without interruption. I can do that because I focus on dividends, and dividends are independent from the market. This slide shows that disconnect between dividends and the market in my own portfolio. The red line is my dividend run rate this year through September 1st. It's up about 11% so far this year, and we're not yet 3/4 of the way through the year. The blue line shows the total value of my portfolio. The dividend growth portfolio is much less volatile than the market as a whole, so it's down only about 5% in total value, whereas the green line shows the market itself as measured, as it usually is, by the S&P 500. I calculate that with dividends reinvested, and that's down about 14%. Here's the upshot of the lines on this chart. The market and my dividend income are moving in opposite directions. The income goes up even when the market goes down. And that's why I keep reinvesting my dividends every month. The market can crash, but dividends don't crash. This slide shows my dividend reinvestment program this year. You can see each month I've listed what I purchased that month, how many shares, and how much income that added. I've highlighted 2 purchases of Merck with reinvested dividends this year. In March, I bought 6 shares and added $17 to the dividend run rate. And again, now, as discussed in this video, I added 6 more shares and added another $17 to my dividend run rate. Let me call your attention to the highlighted areas at the bottom. The total income added through the now 9 dividend reinvestments so far this year have added $143 to my annual dividend run rate. And if you look to the far right bottom, year to date, that's added approximately 2.7% to my annual dividend run rate. So it's a kind of a cool story the way this works. You get the dividends from the company, you reinvest them, buy more shares. That adds to the speed at which dividends come in by increasing the dividend run rate. And over time, that adds percentages to your dividend run rate in the same proportion that the dollars are being added. This slide shows the portfolio's headline statistics shortly after I bought the Merck shares. Here are the major points to note. in the top line, the total value of the portfolio is a little higher than it was a year ago, 1.6% higher. It's down about 4% this year so far, as we saw earlier. The number of positions is down 2 to 29. That's because I've cleared out a couple of the small positions this year as I've been focusing on them. The current yield is up to 3.5%. And it's gone up mainly because prices have gone down, combined with the increased rate at which dividends come in. But the price drop this year has contributed to the increase in yield. The dividend run rate is at an all-time high of $6,004 per year, which is 18% higher than it was a year ago. That's a combination of dividend reinvestments, dividend increases by the companies, and changes that I've made to the portfolio that I've discussed in other videos prior to this one. Finally, the yield on cost, which moves in tandem with the dividend run rate, has hit its all-time high of 12.8%. And just to remind you what that means, it means I am collecting dividends at the rate of 12.8% of the amount of money that I originally began the portfolio with in 2008. That comes to me as cash. It happens every year, and it goes up almost continually throughout the year. And that leads me to show you this, which is my favorite chart for this portfolio. The reason that it's my favorite is because it perfectly illustrates my primary objective, which is to generate reliable, growing dividend income for later use in retirement. This slide shows the amount of income that I've collected each year since I began the portfolio in 2008. 2008 was a partial year because I started at the beginning of June that year. But all the years from 2009 to 2021 are full years showing how much I collected that year. And you can see that every bar is taller than the bar to its left. I've made an estimate now based on how much I've already collected and projections for the rest of the year. I've made an estimate for 2022. That's the bar to the right, and its height is a projection. It's not actual yet. But if you see the dark dot in that bar, that does refer to how many dividends or how much in dividends I've collected so far this year, which stood at $3,542 at the beginning of September. And if you keep your eye on that dot and then scan your eyes to the left, you can see that the amount of dividends I've collected so far this year has already exceeded the total amount that I collected in 2016 and is just barely short of how much I collected in 2017. In fact, mid-month September, I probably already passed 2017's total as well. And of course, by the end of the year, I will have surpassed, again, all preceding years in dividends collected. I should also mention, and this is triggered by a comment I got on my last video about my portfolio, that the total dividends collected, which means if you took all those green bars and stacked them up on each other and got one really tall bar, all the dividends that I've collected since I began the portfolio, that amount is creeping up on the initial amount of money that I used to start the portfolio in 2008. There's just a few hundred more dollars to go, and I should be there before the end of the year. And that'll be a really cool milestone. I will have collected as much in dividends over the years as I spent to create the portfolio in the first place. And remember, as I said, no new money has ever been added to the portfolio since its original creation. Now, to finish up, let's look at the whole portfolio. While you're looking at the portfolio, I'll give you these facts about it. I began it in 2008. It's a demonstration of dividend growth investing in real life. It started with just under $47,000 in value and no income at all. Now it's worth about $170,000 in value, and it's bringing in more than $6,000 a year in income. That growth in both total value and income has been achieved with no new money ever added. All growth has come from within the portfolio via market price increases, dividend raises, dividend reinvestments by me, and occasional portfolio trims and swaps as I manage the portfolio. I started with 10 positions, now I have 29. The annual income has surpassed $6,000 a year, and it goes up at about 10% a year, and the yield on cost has reached 12.8%. And that's the end of this video. Please remember to click the buttons and to leave comments in the comment area below the video. Comments and questions, I do engage in the comment stream and will answer your questions to the best of my ability when you put them there. And that's the end of this video. I'll see you guys next time. Goodbye, everybody.